This webinar originates from a series of webinars produced by the Center on Budget and Policy Priorities. They've been edited to better match the dividing line between relatively simple ACA situations and those that are more challenging. It's primarily intended for the California Tax-Aide counselors and addresses ACA situations that are faced by the vast majority of our clients. Almost all Tax-Aide clients have ACA situations that are fairly straightforward. Counselors who view this webinar will learn how to handle the vast majority of returns and how to recognize those situations that are more complicated. It's recommended that all counselors get this basic training. But what about those few situations that aren't covered by this basic presentation? Another pair of webinar recordings is available for counselors who want to learn how to assist clients in those more complicated circumstances. Those webinars are for counselors whose goal is to become an ACA specialist for their site or district, someone who can be consulted when those challenges do come up. They're referred to as the Advanced ACA webinars. This link points to a document that discusses the complete set of ACA training webinars and has links to all of them, as well as to useful and sometimes necessary resources. You may want to pause this video for a moment to copy this URL. I hope you'll find this series of webinars useful. Comments are welcome and can be sent to the email address on the screen. It'll be available at the end of this presentation as well. Now, let's get started on the first basic ACA webinar.
Hello, everyone. This is Hallie Cloud with the Center on Budget and Policy Priorities, and thank you so much for joining us today. This ACA and Taxes project includes resources and trainings on what volunteer tax preparers need to know about the Affordable Care Act to assist low-income tax clients with the healthcare portions of the tax return. It is intended for volunteer tax preparers, outreach partners, and others who assist low-income tax clients, and it is not intended for press purposes. This is a project of the Center on Budget and Policy Priorities, which is a nonprofit policy think tank in DC. Today's webinar will go over basic ACA certification topics for VITA and TCE volunteers, such as the requirement to maintain minimum essential coverage and how to claim an exemption from the requirement to maintain health coverage. So with that, I'd like to welcome Tara Straw, Senior Policy Analyst here at the Center, who is going to walk us through our topic today.
Thank you, Hallie. Let's start with the basics. The ACA requires coverage or an exemption or payment of a shared responsibility payment for every person on the tax return for every month of the year. So that's how we're looking at this. You have to have one of these things for every month of the year for every person on the tax return. Minimum essential coverage is basically just about every kind of coverage you can think of. It's a pretty low bar, so it includes all employer-sponsored coverage through groups, through COBRA, the coverage that you are offered when you leave a job. It includes retiree coverage. It also includes individual market coverage wherever it's purchased, whether it's purchased through the marketplace or directly from an insurance company or as part of a student health plan. It includes government-sponsored programs like Medicare, nearly all Medicaid, CHIP, TRICARE, even Peace Corps coverage. And then there's a grab bag category of coverage for certain other coverage. These are types of plans that have been designated by the Secretary of HHS, and so there are just a few oddball type plans in there. And if you have coverage for one day of the month, you're considered covered for the whole month. So we're not looking for people to have coverage for every day of the month. We're not requiring, more than half of the month. It's just one day of coverage is enough to count for the entire month. So we're going to incorporate some tax layer screens in here. Many of them are kind of obvious, but some of them get quite tricky. So we're just going to go through as many as we can. The first screen that TaxSlayer gives you on the health insurance section is just asking, does anyone have any coverage? And if you answer no, then you'll go straight to the exemption section. If you answer yes, then you'll give more information about who had coverage and when. You're also asked to verify your household members. And you're given an option, you're given the option 3 times on this little screen, actually, to add a new household member. So what does that mean? Adding a new household member is what you would do if you had someone who qualified as a dependent, but you're not claiming as a dependent. And this is, a tricky, slightly controversial rule that's in the ACA regulations and also in the form instructions that say that your household includes people who you could but don't choose to claim as a dependent. And so this is where you would add those people. Now, I will say in practice, I've actually never seen this happen. In general, people are claiming the dependents they are eligible to claim. I maybe have had 1 or 2 families that pose the question, well, can I just take these kids off so I don't need to pay a penalty for them? But then every time we did the math, it was always more favorable to keep them on anyway. And so we didn't need to get into a big, conversation about specific rules, because, the taxpayer, could vote their own interest and see that it was better to keep the dependent on the tax return. So don't get too tied up in that. But just because they give you this option 3 times on 1 page, that's why they do it. Then you're asked if the entire household was insured for all 12 months. So obviously, if you answer yes, then they're going to skip all the exemption screens. Otherwise, you'll be entering in the months insured for each person, and then specify which months. The shared responsibility payment is owed if a person does not have coverage or an exemption for a month. It is based on a formula. We're taking whichever is greater of these 2 things, either a flat amount of $695 per adult or a percentage of income of 2.5% of household income over the income tax filing threshold. So the greater of those 2 amounts. Now, it is a formula that's indexed by some kind of cost of living adjustment, but the numbers actually didn't change from last year, so it's the same figures as last year. But new this year is that the IRS will not accept electronic returns that omit health coverage information. So last year, you'll remember there was a big hubbub at the beginning of the year about the IRS, that the IRS was still accepting returns that didn't have any kind of health information on them. And I know that this got out, and I actually did have a few clients who wanted to just not do the health questions because they knew that they were going to pay the penalty. So the taxpayer did not give us the option last year to skip over those questions. And this year, the IRS is finally cracking down and saying that they're not going to accept returns that omit health coverage information. So if you used that option last year with particular clients, just know that it's not an option this year. Taxpayer does give you an awful lot of information about the shared responsibilities payment. They give you 5 pages of toner that you'll never get back. So the first 3, there's a lot of words there. No one's going to read them. I do find the 4th page to be fairly useful, because on the left side of this worksheet A, it tells you which members of the family you are calculating a penalty for, which is good because, maybe you have, one thing on the intake paperwork and you had a conversation about another thing and you just kind of got confused in the back and forth. So this worksheet will tell you which members of the household you are calculating a penalty for and for which months. We're going to talk through all of the different types of exemptions. As you know, the exemptions must be claimed on Form 8965. There are 3 parts to this form. The first part is for marketplace granted coverage exemptions. These are very rare. The most common type of exemption that you have from the marketplace is people who tried to enroll in coverage and were told that they couldn't enroll because they had low income and their state hadn't expanded Medicaid. So those people, as part of their notice about their status, which is that they weren't eligible for coverage, they'll also get an ECN. Now, many people don't keep that or don't remember to bring that for their taxes, but that is the most common kind of marketplace granted exemption. Next, part 2 is an exemption for the entire household if household or gross income is below filing threshold. This is unique because the other exemptions are really by person, and this is for a household. And then finally, in part 3 are individual exemptions, and these are the ones with the codes, and you indicate the name of the individual, the type of exemption, and when they qualify for the exemption. And then you immediately get to this screen in TaxSlayer, and I just call this a speed bump because this is a really out of place screen for a lot of reasons, and we're going to sort of go through those reasons. But when I train volunteers, I'm going to train them to skip this entirely unless they've done all of their homework on exemptions. I think that this is just in the wrong place, and it's a little misleading because I've had more experienced volunteers who just go straight to this, and they start, asking questions about, okay, well, how do I find the lowest cost bronze plan? And then if you were to just click through to the next screen, you would find out that they didn't need it anyway. So, just in view of having volunteers not do work that they don't need to do, I would have them skip over this screen for marketplace affordability exemptions. We're going to talk about part 2, which is the coverage exemption for income, household income or gross income below the filing threshold. I do have the definitions here just because it's a little confusing. TaxSlayer does calculate both of these, which is great, but they don't tell you which one a person has been found eligible for, since it's now all just one part of, line 7 on the 8965. So it's useful to know, though, some of the differences, because you might find that a person who is not eligible for one of these exemptions is eligible for the other. The biggest example is, or the most common example that I've seen, is someone who is not eligible for the household income exemption because they have a dependent who has a filing requirement and who has income, and that's included under household income, but they do qualify under the gross income test for this exemption because it does not include the income of any dependents. But just in case it's useful, these are the definitions for those 2 categories. And then if you click through, you will get a notification that you qualify or you don't qualify for the coverage exemption for household or gross income. Now, I will say that I had a surprising number of volunteers, particularly the experienced volunteers, just click right past this because they tend to not read what's on the screen unless it's in the form of a question. So this is one area where, people have got to slow down, because if you don't see that notice that someone qualifies for an exemption, you're going to do work you don't need to do. And some people really got sucked into that and were very disappointed to learn that all of their work on the affordability exemption was for naught. And no matter how you answer the other question on this page, did you qualify for an exemption, you're still going to get that line 7 exemption for income below the filing threshold. Even if you answer no, that you don't qualify for an exemption, it's still going to give it to you on the 8965, which is great. If you don't qualify for the line 7 exemption, then we're going to consider eligibility for other types of exemptions. Remember that these exemptions can be claimed monthly or for the entire year. And if someone qualifies for multiple exemptions, you're only entering one. And the rule for exemptions is the same as the rule for coverage, which is if you qualify for one day of the month, then you qualify for the whole month. So here's our list of coded exemptions. We're going to talk about a few of these, the most common, and we're not going to spend time on exemptions like Code D, members of a healthcare sharing ministry, E, members of an Indian tribe, which may be very common in certain pockets of the country, but it's also pretty self-explanatory. Code F is also self-explanatory, incarceration. Sometimes there's some gray areas of what counts as incarceration, but you can always pose additional questions about that. But we're going to hit the most common exemptions. So you're in TaxSlayer, you're going to, first answer this question, did you qualify for an exemption? Yes. And then you're going to have the opportunity to select the individual's name and to get to the drop-down box that lets you pick the type of exemption. Now, it's still frustrating to me that they list the type of exemption without listing the code, because I do think it's important to know the code because it helps you reference the IRS instructions. And when you have questions, you want to go to the instructions, and the code is a nice, handy way for you to figure out how to get help. Especially because you have a couple of exemptions that sound pretty similar, like the code A, coverage is unaffordable, and then the code G, coverage is unaffordable for a different reason. So it's frustrating to me that they don't include the codes, but they don't. So first is short coverage gap. This is people who are uninsured for less than 3 consecutive months. So really we're talking 1 or 2 months and some change. If the coverage gap is 3 months or longer, then none of the months are going to qualify for the exemption. And if there are multiple coverage gaps during the year, only the first gap in coverage can use this short coverage gap exemption. A person is, again, going to be considered to have coverage for the entire month if they have coverage for 1 day in the month. And that leads to some funny results here, because you have periods that seem longer than 3 months, but really will still qualify for the exemption. So in this example, Bob is uninsured January 5th to April 28th, and the exemption is going to apply in February and March, and that's because he's considered to have coverage in January, he's considered to have coverage in April, he only needs an exemption for those 2 months in between, even though the gap between January 5th and April 28th looks large. Months covered by another exemption are treated like months with coverage. So this is another way to make what looks like a big gap in coverage actually look smaller. So in this example, Bob has coverage January to March. He's uninsured April and May, and is eligible for an affordability exemption June to December. So even though Bob was uninsured for a long period of time between April and December, he's going to be eligible for a short gap for April and May, because June and the rest of the year will count as covered months because he's eligible for another exemption. And there's a look back period, but there is no look forward. And what we mean by that is that consecutive uninsured months at the end of 2016 are going to count toward a gap at the start of 2017, but uninsured months in 2018 do not. So if Bob is uninsured and is not exempt in December 2016, January and February of 2017, he's not going to qualify for the short gap exemption in 2017 because the gap is greater than or is equal to or greater than 3 months. So he won't qualify for exemption. But if someone comes in and let's say they were uninsured only in November, December, and then January and February, you see them in February, and they've been uninsured since November, you can still give them the short coverage gap exemption because we're not looking forward. We're not looking forward to 2018. We're only looking at 2017. Code C is for citizens living abroad and certain non-citizens. There are a lot of people who are lumped into this exemption. The most common group that you'll see at some of your tax sites are people who are not lawfully present. This exemption includes, a broad range of people who are not U.S. citizens, nationals, or lawfully present. It also includes some people who are citizens but who are living outside the United States and who are filing 1040 NR. You can, it's a little tricky to identify people who are eligible for this exemption. Sometimes you'll know just, from your interview of the client, you'll have an idea that they qualify for it. If you have someone with a confusing immigration status and you're just not sure, there is a list of who qualifies for help with healthcare costs. And if they qualify for help with healthcare costs, then they're not eligible for the exemption. So you can look at that list on healthcare.gov. But oftentimes it can be clear. Also, does everyone with an ITIN get this exemption? Many people with ITINs will be eligible for this exemption because many people with ITINs have them because they are not lawfully present. But that's not true of everyone with ITINs. For example, foreign students have ITINs. Some people with Social Security numbers are eligible too. So someone who is a DACA grantee, a dreamer, and has a Social Security number is actually not eligible for premium tax credits, and so they are eligible for this exemption, the Code C exemption. So you can't quite draw bright lines between ITINs and SSNs, but those are some of the rules of the road. Next is people who were members of the tax household who were born, adopted, or died during the year. So this exemption is sort of needlessly complicated. It's important to know our starting point. Our starting point is that coverage is required in full months alive or post-adoption. So if someone was born in February, they don't have a coverage requirement in February. If someone was adopted in September, they don't have a coverage requirement in September with their adopted family. So our example is that a person dies May 14th. Coverage is required January through April. It's not required for May. And so May to December, you can use this Code H. I really think of this as like a gap filling provision that is probably intended to help software developers and the IRS's own computers figure out what happened during a year, because otherwise, if you didn't have any indication like a Code H, you might accidentally calculate a penalty for months before birth or after death, and we wouldn't want to do that. So this exemption helps us fill in some gaps. Although if everyone in the tax family had coverage all year, you can just sort of throw in the towel and check the box on line 61. Just say they all had full year coverage and not worry about claiming Code H for someone. So following through in our example with Rashid, he's going to claim the exemption Code G. Layla was born in November. She was covered by Medicaid retroactive to the date of her birth. So she was covered for November and December. On their tax return, they would claim Code H for Layla in January through October. They could also claim it for November, but they don't have to here because she had coverage, but they would be eligible to claim it in November too. Let's move on to the premium tax credits. So you know by now the general requirements for a person to take a premium tax credit. First, a person has to enroll in a marketplace plan, so you can't use this credit for other types of plans. You have to have income between 100 and 400% of the federal poverty line. And there are exceptions to the 100%, and we're going to talk about that in more detail and how that's handled in TaxSlayer. You also have to have an eligible filing status. By that, I mean that a person who wants to claim the premium tax credit cannot be married filing separately. There are some exceptions that we'll talk about later, but in general, married filing separately, just like it excludes you from the earned income credit and other credits, it also excludes your eligibility from the premium tax credit. The premium tax credit also can't be claimed by on a dependent return, so it has to be claimed by the person who is claiming the dependency exemption for that person. And you can't claim the premium tax credit if you're eligible for or enrolled in other minimum essential coverage. And there are actually a lot of exceptions to this, which we're going to talk about later in the presentation. But in general, if a person is enrolled or eligible for Medicare, CHIP, or employer-sponsored coverage, they're not going to be able to collect premium tax credits. If a person received any advance payments of the premium tax credit, they must file a tax return. This includes people who have a member of their family who received premium tax credits in advance, or if a member of the family who is not on the tax return, if a member of the tax family purchased insurance in the marketplace and didn't receive the credit in advance but wants to claim it now, so they didn't take APTC, but now they want to claim the credit and they're otherwise eligible. Or if a person got APTC for a dependent, but the dependent is not claimed and no one else claims the personal exemption, so the dependent kind of drops off not only the taxpayer's return, but they don't file a return themselves. In that case, it's the taxpayer who's ultimately going to be responsible for that. So the example of this is Diane enrolls her 19-year-old son, Danny, in marketplace coverage, assuming she will claim him as a dependent. At the end of the year, he can't be claimed as a dependent. Danny can file taxes, but he doesn't. And no one claims his personal exemption. In that case, Diane must reconcile the premium tax credit. So it's basically batting cleanup here. Someone needs to reconcile this credit. And if Danny isn't going to do it, then his mom has got to, because that's the basis on which he got the premium tax credit to begin with. Although I have to say it's difficult, and the IRS will admit it's difficult to actually figure out how to administer that part. If no premium tax credit is taken in advance, or if only a portion of the credit is claimed in advance, the remainder is refundable and can be claimed on the tax return. On the other hand, if a taxpayer receives excess advance payments, some or all of it must be paid back. There are caps on repayment for most people. You can see the caps there. They haven't changed since last year. There is no cap for people who have income at 401% and above. In that case, they'll be paying the full amount back. So here is your 1095-A. And here's a quick tour of the important things that are also the most common things that people get confused on. So first column A, we have monthly enrollment premiums. This can be confusing because this is the actual premium. This isn't the premium that the enrollee paid. So this is not just the enrollee's share, but also includes any amount that was paid for APTC. There also might be some slight difference in benefits than what the person has enrolled in. But the biggest difference is going to be that, you know, the person who is enrolled usually isn't going to recognize that premium because that's not what they pay every month, because it's the total premium. Second, we've got the monthly second lowest cost silver plan premium. You'll hear a lot about second lowest cost silver plans. This is the benchmark plan that helps establish the premium tax credit amount. It could be incorrect on the 1095-A if no APTC was paid. In that case, it's usually left blank. Or if there's a change in circumstance that wasn't reported. So there was someone who was on this, someone who enrolled with this family but didn't, but now isn't on the tax return. So if there's some difference between the people who are enrolled and the people who are on the tax return, then the amount here may be wrong. And the good news about that is that you can look up the second lowest cost silver plan in healthcare.gov if you have a state that uses that platform, or in your state marketplace platforms. So if this is incorrect, you can just look it up and use the correct amount. You don't need to seek a correction for the 1095-A. So it does avoid that extra time delay and sort of administrative hassle of getting a corrected form. And finally, column C is the advance payment of the premium tax credit. If the 1095A is wrong, the taxpayer should call the marketplace for an amended form. But like I said, you don't always need an amendment, and you don't always need to delay just because you need an amendment. So if there's an error that doesn't affect the premium tax credit calculation, then yes, they should still seek a correction, but you can still continue to file. You know, if you're just waiting for a change in address or social security number or birth date, I wouldn't let that delay the return, but they should still seek a correction just to make sure sort of all the records match up. If an error does affect the premium tax credit calculation, you can get corrected information before filing, and often the consumer will be able to get that information over the phone. Sometimes it needs to go through a couple of different layers of review and escalation before they can resolve the issue. But in general, you'll be able to get an answer over the phone, which you can use to complete the 8962 and just get that mailed off without waiting for the paper. With 1095A corrections, they batch the responses, and so they don't just send every decision or every corrected form as it's ready. They send corrected forms, you know, say once a month. And so your corrected form, even if it's done and ready to go, will need to wait until their next official mailing date. So that's why there's so many delays in getting even an easy correction. And as I mentioned earlier, if the only thing that's wrong is that the SLIC-SIP or the second lowest cost silver plan is blank or is incorrect, then just look up the correct one and use it. They're not going to process an amendment for an incorrect SLIC-SIP. So here's some taxpayer screens. These are the basic ones. If someone did purchase coverage in the marketplace, they should answer yes to that question. Then you'll be asked to verify the household. If you joined us yesterday, we talked about this provision. We're not going to belabor the point, but there are some ways that you can add a new household member. The way this might come up incorrectly in the premium tax credit context is that sometimes the family has changed between the time they enrolled and the time they file a tax return. So for example, you know, if someone has their, you know, college age dependent that they plan to enroll with as a family at the beginning of the year, and at the end of the year, it's clear that that person wasn't a dependent for the year, they earned too much money or paid, you know, more than half of their support or whatever. So they're not a dependent. So you'll have a 1095A that reflects the whole family. And you will have a tax return that reflects only certain people and not that dependent. So when there's that kind of mismatch, that's going to be out of scope because you need to do a special treatment of that 1095A to kind of carve it up between two tax returns, one for the parents and one for that person who is no longer a dependent. That gets more complicated than we can talk about, and it's out of scope for VITA and TCE. It also can't be done in TaxSlayer, so we can't even give you hints even if we wanted to. Okay, and then as you know, you're going to enter the number of months insured and which months those were. And then you'll be asked if you received a 1095A statement or any premium tax credits, because of course, if a person did not get a 1095A statement but did receive APTC, they still need to reconcile. They just need to figure out where that 1095A went. So here's where it gets tricky. If you answer this question yes, you get this series of questions that pops onto the screen. And we're going to take each one of those and break them down because there are really just a ton of pitfalls here, partly due to, you know, some weird requirements in the law, partly due to some poorly phrased questions. So let's break this down. So one of the questions you'll get, are you required to repay all of the APTC received? They did include some explanatory text, which we recommended when they added this requirement last year, or added this question last year, kind of mid-season. And it says, in most cases, the answer is no, and only answer yes in certain circumstances. So let's talk about this. The people who need to repay all APTC, it's a very, very small group of people. This is people who are not lawfully present and received a credit only for themselves. And I say that because if someone was not lawfully present, but they had 2 kids that are U.S. citizens or who are lawfully present, who also received coverage through the marketplace, and they're all on the same 1095-A, then you shouldn't just require them to repay all the APTC, because 2 of the 3 people were eligible to receive APTC. So that gets too complicated. It's out of scope. It's handled not in the form instructions, but in a separate publication, publication 974. So, you know, it's a very rare case where you're gonna encounter anyone who made it through all the verification systems, being not lawfully present, and make it to your tax site. The other circumstance is someone who received APTC and also received the healthcare tax credit payments. The healthcare tax credit payments are really sort of too complicated to explain. This is not the same as the premium tax credit. It's a special credit that's available to a certain group of people who are in certain industries that have been sort of affected by trade. It's a very small group, and so chances are you'll never encounter someone who is eligible for the program, let alone who is eligible and is enrolled in the program, which is a very small group. And then finally, you've got people with income over 401% of the federal poverty line or above. So those people the taxpayer is going to automatically handle those people. So it doesn't matter what you answer for this question for that group, the taxpayer is going to take care of it, which is good. But who does not need to repay all APTC? People who are eligible to claim the credit, obviously. People who are not eligible to claim the credit, such as people who are married filing separately or who have other health insurance coverage. So let's take the example of someone who's married filing separately. You know that's a filing status that excludes them from eligibility for this credit. But that doesn't mean that they need to repay the full amount. Their repayment is still subject to the repayment caps. And so it's important to know this when you're answering this question. You know, don't look at that population too broadly, because many, many people, the vast majority of people, are going to be covered by the repayment caps. So in the vast majority, 99.9% of cases, you're going to answer no to this question. And if you don't answer no to this question, if you accidentally answer yes and say that the full repayment is required, you're going to see something like this, where if you look at line 28, there should be a repayment limitation in there if the caps apply. And whether the repayment limitation is used, so if your repayment limitation was $600, but in the credit you only owe $300, then even if the cap wasn't used, wasn't applied, it should still appear in the box on line 28. And if it doesn't, then you should go back and see what happened. The next question is your household income below 100% of the federal poverty line, and do you meet all of the requirements under these 2 provisions? So let's talk about that. The rule is that a person with income under 100% of the poverty line can claim the premium tax credit if they were enrolled in marketplace coverage and received APTC. The other way that they can claim the credit if they're under 100% is if they're a lawfully present person who is ineligible for Medicaid. But honestly, you really just kind of have to teach one of those things, because in the vast majority of cases, the broader category of people who have income under 100% and received APTC sort of subsumes the other category, which makes it a little easier. Now, TaxSlayer only presents this question if someone does have income below 100% of the poverty line. But that's my experience. Your experience may vary, but this question doesn't pop up for everyone. So if your income is above 100% of the poverty line, I think in most cases it's not going to pop up. So it only pops up when it's relevant, which is good. The problem is that it defaults to no, which is going to be the wrong answer for many, many, many people. So the consequences of answering no, if you happen to have income between 100 and 400, answering no is going to be fine. The program is going to either handle it or skip the question altogether. But if someone has income below 100% of the poverty line and you answer no, you're going to be triggering repayment for this person. So repaying the entire amount of the premium tax credit that was received in advance up to the repayment cap. So we don't want to do that. Again, 99.9% of cases, you're going to answer yes here. You'll answer yes if a taxpayer has income below 100% of the FPL, but is eligible to claim the credit. So those two questions are really tricky and can provide a lot of kind of headaches for people. Here's what it would look like if you have income below 100% of FPL and you're triggering repayment. So you can see in line 6, it answered the question yes and says you are not eligible to take the PTC. And if you see below, it doesn't matter what you entered as far as monthly enrollment premium, et cetera. It's going to blank all of that out and just list the advance payment on the last column. And it's going to make you repay all of that up to the cap. So you can see it's applying the cap in lines 28 and 29. So that's bad. And there should be very few people who are going to have a circumstance like that. And so if you see that as a reviewer, you should go back, look at these questions, consider, if someone had received APTC because they thought they were eligible for this credit. In a few cases, I will tell you, I have had examples in TaxSlayer where the question wasn't even asked if someone had income below 100% and they did have income below 100%, and then this exemption was, this repayment was automatically applied. So that's bad. It only happens sometimes for me, so I'm having trouble recreating it in a useful way for TaxSlayer, but just be aware of that. Hopefully this is just some weird glitch. Okay, so next, the rest of it is more self-explanatory, luckily. You'll be asked to either enter the monthly amounts or the annual amount. This is a little confusing to some volunteers because some people thought that you could enter the annual amount if, let's say, someone was enrolled in coverage from January to March and then was not enrolled in coverage the rest of the year. Some people thought you could just enter the annual amount if January, February, and March were all the same, and even if the rest of the year was blank, but that's not the case. In order to enter the annual amount, all 12 months have to have coverage, and it has to be the same, and each box has to be the same for all 12 months. Then you'll be asked to enter the dependent's modified AGI. This is only required if the dependent has a filing requirement. So let's look at some complex 1095A issues. So, what are you looking at? So the first case I said we'd come back to is a taxpayer who cannot claim premium tax credits because they are married filing separately. There are two exceptions to this general rule. The first is domestic abuse. So the taxpayer lives apart from their spouse and they're unable to file a joint return because of domestic abuse. The second exception is an abandoned spouse. So the taxpayer lives apart from the spouse and can't locate the spouse after using due diligence to file a joint return. So in each case, the person can file married filing separately, and then they'll be asked, to check this box if you're filing a separate return only because you're a victim of domestic abuse or spousal abandonment. Now, each of these exceptions can only be used for a maximum of 3 consecutive years. And now we've had 3 years of experience with this. And so if people have claimed this in multiple years, this may be the first year that we have to say, no, there's a limit of 3 consecutive years. So here's an example of that. Alma hasn't seen her husband in over a year. When she applied for health coverage, she said she was single. She was awarded a PTC. At tax filing, you inform Alma that her filing status is married filing separately. Explain that a person cannot claim PTC if married filing separately, and ask if domestic violence or abandonment exceptions apply. Now, abandonment might apply. She said she hasn't seen her husband in over a year. So has she used due diligence to locate him? And her answer is, he lives with his new girlfriend in Arlington. I could call him on his cell phone, but I don't have any interest in filing taxes with him. Well, in that case, the exception does not apply because you have to use due diligence to locate the person. So if you know where they live, then you're not going to be able to take this exception. And if you can't take the exception and you're just married filing separately, it's going to trigger full repayment, which is going to look like this. You'll just see the amount in column F. You won't see the amounts in other boxes. You'll see that amount in column F. And if you just see that, you'll know that you're triggering full repayment. Another issue is that some people come in with multiple 1095As. Now, I hope that this won't be as prevalent as it has been in the past, because in the past, the marketplace computer system was set up strangely to generate a new 1095A to basically consider it a new policy every time someone made a change, even if they made a change that wasn't even related to their coverage. So if they just made a change in income, but it didn't change their coverage, it was triggering a new 1095A. I've heard that if it was just related to change of address, that was still generating a new 1095A. So then people end up with multiple forms, and how do you deal with that? In general, you're going to, for column A, you're going to take column A on each of the 1095A forms and add them up together. Column B, if people enrolled together, column B should reflect the SLIC-SIP for everyone. And so if you have parents enrolling and a non-dependent child enrolling, and they can all enroll together, the child's under age 26, then you might have a form where you add the premiums together for column A, and where their column B SLIC-SIP is actually the same. It's the same on the parents form and the dependents form. In that case, just take it as it is. Don't add them together. If they're in different states or different coverage areas, then they might be different. So in that case, you would add them together. But if you're ever unsure, you can always just use one of the tools to look up what the appropriate SLIC-SIP is, and then just use that. And then column C, you're going to add the APTC amounts together because those have been divided between the two 1095As. So here's an example. Felicia and Murphy claim their 27-year-old daughter, Gwen, as a dependent. They enroll together as a household in the same plan, but they can't be in the same policy because Gwen is over age. So they get separate 1095A forms. Mom and dad get a 1095A form that shows $12,000 in premiums, $4,800 in APTC. The 1095A for Gwen shows $3,600 in APTC, the same SLIC-SIP, and $1,200 in APTC. So then when we're entering the annual premium amounts, we're going to, for the premium amount, we're going to add the two 1095As together. We're going to take this SLIC-SIP as it appeared on both forms. We're not going to add it. And then we're going to add together the monthly APTC. Another issue that you might see when you're looking at a 1095-A and you're trying to figure out how to treat certain months is a blank amount in the monthly enrollment premiums. So what this means is that the person didn't pay their premiums for a month. And there is a 3-month grace period for non-payment of premiums. But if a taxpayer doesn't catch up on all the missed premiums, all 3 months, coverage is terminated retroactively as of the end of the first month of non-payment. So in this example that I have here, where you see payments in January through April, but a blank spot in May, that means that they failed to pay their premium in May, June, July, and had their coverage terminated retroactively to the end of May. And so they still have this outstanding premium for the month of May. Now, a taxpayer has 2 choices. They can either pay back the APTC, that $200 for the month of May, or they can pay the premium for the month of May prior to the tax deadline. So in this case, we have a monthly enrollment premium of $400, and we have tax credit of $200. So for May, the consumer owes roughly $200. They can either pay that $200 to the insurance company, or they can pay back the $200 in APTC on their tax return. Now, if there are multiple months where there's APTC and there's no enrollment premiums, that's probably a mistake. And so that person needs to go back to the marketplace and say it's a mistake. We'll probably need to involve the insurance company in getting it corrected. And I will say that it's especially important now to raise the issue of a taxpayer paying back the premium, because there's been a change in rules, and now insurance companies can deny you coverage next year if you have any unpaid premiums from the past. And so this person might have trouble getting into coverage in a future year because of this unpaid premium. So from the perspective of not wanting to pay back the advanced PTC and wanting to make sure that you don't have any blocks to enrolling in the future, it's really helpful to pay the enrollment premium. So just know that that's an option. So we have an example here. Greg had an unexpected car repair in April, could not afford to make his $200 May premium for his marketplace insurance. He made no other payments and his coverage was canceled retroactive to the end of May. So when you enter this into TaxSlayer, if you enter it just the way it is on the 1095-A, then it's going to trigger the repayment of that $200 in APTC that he received in May. Even though Greg didn't pay his premium for May, he is still considered covered for that month. So that's important to know. So when you're entering in the months Greg had coverage, you're going to include May in that. As an alternative to repayment, Greg can pay his portion of the May premium, request a new 1095-A, and avoid the APTC repayment for that month. So you would still want to request a corrected 1095-A. So the healthcare.gov records or your state marketplace records match the information that the IRS has. So you'll want to see that change sort of be reported. But that would be a case where I would say you don't need to wait for a corrected 1095-A to proceed. If someone knows what their premium was and just sends it to the insurance company before the deadline for tax filing, then I think that's good enough. You can just consider that a coverage month or a paid premium. And you'll know that someone is not eligible for a premium tax credit for a month because in column E, there will be a blank space. So if you see that column is the monthly premium tax credit allowed, and if it's blank, then you should figure out why was there a premium tax credit denied for that month, because that's a month where where the person will have to repay APTC. Okay, so what if there is a number in column A but there's nothing in columns B and C. What does that mean? That means that if that someone was enrolled in coverage, but they didn't receive APTC for that month. So this person was enrolled in coverage in April and May, but didn't receive APTC. In this case, you would determine eligibility for the credit for those months where the premium was paid and there was no APTC. Because there's nothing here telling you that they're not eligible, that they just didn't receive APTC. Maybe they told the marketplace, you know, stop paying the advanced credit, I just want to take it all on my tax return. So now is their chance to take it all on their tax return. And in order to do that, you will need to enter in a SLIC SIP, and the credit will be calculated. If you don't enter anything on column B, it's not going to calculate the correct premium tax credit, and people will be losing a big chunk of their benefit because it won't be calculating for those months. So all you need to do is enter in the SLIC SIP. In this case, if there was no change in the year, I would say just borrow the 300 from above from the January, February, March months. If there has been a change in circumstance that makes you think that that's not right, then you can just, again, look up the correct SLIC SIP. So here's another example. Carolina failed to reconcile her APTC for 2015, and so she had her 2017 APTC canceled. She filed her 2015 tax return late, and APTC was reinstated starting in March. So you can see what the 1095A would look like. It would show her premiums. These are paid premiums in January and February, and then the APTC kicks in starting in March. So even though she didn't receive APTC in January and February, she still meets all the criteria to claim it now. And so in TaxSlayer, you would enter in the SLIC SIP for January and February. You can either look it up, or if nothing in her situation has changed, I would, use the amount from the other months. But leave the APTC column blank for January and February. She didn't receive APTC, so don't say she did, because then she won't get her full benefit. One questioner asked, if a taxpayer used the short coverage gap exemption in December 2016, can he use it again in January 2017? And the answer is maybe. It depends on what was happening in, November and February of those years. If he was uninsured in December and January only, then January can qualify as a short coverage gap month because the gap is less than 3 months. And so even if he claimed the short coverage gap in December and claims it again in January, it's all considered one gap, even though it spans 2 years. So as long as it meets the definition of a short gap, which is less than 3 months, then that's okay. So if he was uninsured in November and December of 2016 and January of 2017, January is not going to qualify as a short gap month because the total period is 3 months or more. So that's the distinction of whether or not whether it's more or less than 3 months, not whether you claimed it in December, claimed the short coverage gap in December, and then want to claim it again in January. But I will note that if he had received a different type of exemption in November and December of 2016, the 2016 exemption period would be treated as coverage, and the short gap may apply for January. So, that's the tricky part. Remember that the general rule is that an exemption period will be treated as coverage, and so that means that you can kind of stack some of these exemptions. You can stack an affordability exemption with a short coverage gap. You can do consecutive months of a short coverage gap and incarceration, and you can do that because the gap is narrowed by the other exemption. But the short coverage gap can't be used consecutively if the total time period is greater than 3 months across the year. So I know that is maybe unclear, but you can ask follow-up questions on it if you'd like.
How do you know if the second lowest cost silver plan is wrong? How would you sort of know that a 1095A would need that to be corrected?
The way that you would know, I mean, it's a little hard to know, honestly, but the way you might know is if there is something, if you put in the information and you see like a big repayment, and there's just something screwy about how the 8962 is working out, I always do a little check on the second lowest cost silver plan, just a quick check to just make sure it's right in case it's wrong. Also, if the taxpayer happens to tell you about some change in their family during the year, so that they thought that they were going to claim their son, but their son isn't eligible now, at the end of the year when you're talking about dependency rules, then that might be a flag for you too, that, oh, well, you thought you had this dependent, you didn't, so your family size is different, and that is going to change your second lowest cost silver plan. So those are the things that I would look for.
Perfect. And then along those lines, if you have you have parents who have a child and they obtain marketplace coverage for the whole household, the child is a dependent, they receive APTC. Midway through the year, the child gets a job and moves out of the household. The 1095A for the parents includes the child, but the parents file their tax return without the child, and the child files their own tax return. How do you handle this?
That is a shared policy allocation. That is the textbook definition of a shared policy allocation. When you have one 1095A that has two tax households on it, then that becomes a more complicated situation, and that actually becomes out of scope.
Perfect. And then if a 1095A is incorrect and a volunteer puts in the corrected amount for that second lowest cost silver plan without getting a new 1095A, will the return be rejected, or is that fine to do?
No, as long as the only problem with the 1095A was the second lowest cost silver plan, if that was the only thing that was wrong, or if that column was blank and now you're filling it in, then the return should not be rejected, and there shouldn't be like a 12C letter or anything like that.
Then for those situations where you have someone who has income under the poverty line and they received APTC, are they subject to the repayment cap, or is there ever a situation where they would need to repay full APTC amounts?
So this combines two issues. It's kind of like your double whammy of wrongness of the two questions that are so complicated on in tax layer. So the two issues are, do you have someone who has income under 100% and is eligible to claim the credit, and is the person subject to, or sorry, they phrased the question the other way, does the person have to repay all APTC? So there should be, I can't say that there are no cases, but you're taking sort of the two rarest circumstances and saying that they both have to occur in order for this example to be true. So that's how rare we're talking about. For the most part, people who receive APTC and have income under 100% of the federal poverty line are going to be eligible for this credit, even though tax-wise defaults to the other answer. And in general, people who receive the credit are going to be subject to the repayment caps. They're not going to have to repay the full amount of the credit unless they meet some certain circumstances, like having income over 400% or being not lawfully present. And it's very hard for someone who's not lawfully present to get this far, where they have gone through the immigration screening at the beginning of the process and yet still manage to collect the premium tax credit. So we're talking about pretty rare circumstances. So I can't say that it would never happen that someone under 100% would have to repay the entire credit, but as I said, it's sort of taking two really rare circumstances and asking if they could both occur together.
I hope you've enjoyed this presentation. I also hope that by now there will be more training materials available. Check out the current status at this URL. As I mentioned at the beginning, your comments are welcome. Have a great tax season.